Thank you everyone for attending this month's market update webinar for the month of April 2026. As always, let's start with some disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and unless otherwise stated are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing anything within the presentation. And of course, past performance is not a guarantee of future results. You can read more disclosures on our website. And throughout the webinar, please feel free to use the Q&A button at the bottom, and we'll answer those at the end. So you'll notice today I'm alone. Gordon is spending Passover Seder with his family. So we're going to do it old school, where it's just me monologuing for 30 to 45 minutes, like it was 2 years ago before Gordon joined. So just a bit about who we are. So Silverstone Financial is a fee-only fiduciary, independent wealth management firm. We provide comprehensive wealth management services, including financial planning, investment management, tax preparation, estate planning, and so on. You can learn more about us on our website. And my name is Jeremy Eppley. I am a financial planner that specializes in inheritance optimization and gift and estate planning. My business partner, Gordon, who is not here today, is also a financial planner who specializes in retirement planning and values-aligned investing. Hopefully, he'll be back next month, and I won't be monologuing solo, and we'll have a little bit of dynamic back and forth, but we'll make it fun. So let's get into some graphs. This is for March 2026, the month-to-date performance. This is our heat map for those that are new here. So one of my favorite ways to look at the markets, this heat map, the larger the box, the more valuable or the larger the company. The redder the box, the worse the performance over the past month. The greener the box, the better the performance. And you can see is also separated into various industries like technology, consumer cyclical, real estate, energy, healthcare, financials, and so on. We can see right off the bat that it is quite a red month, which probably isn't surprising for anyone attending the webinar or listening to this as a podcast or watching it as a video after the fact. We are, of course, in the midst of a war with Iran. Even if it has not been technically declared a war by Congress, it definitely has been considered quite a let's call a kerfuffle in the markets. We can see that there were big sell-offs across the board, except essentially in energy. So energy is oil and gas mostly. And because of the war in the Middle East, where a lot of oil is produced, oil prices have shot up. They have shot up 51.3% over just the month of March. And because of higher oil prices, unsurprisingly, we expect some of the large oil producers like ExxonMobil, Chevron, Shell, and so on to have higher profit margins, and therefore their stocks went up. But everywhere else, mostly went down. A lot of the mega cap names, Nvidia, Apple, and Google, go down just with the markets. They are, it's usually part of what's called a risk off trade, where you're selling the entire market because of volatility, uncertainty with the war and such. But other names that were probably specifically hurt, you could see some of the airplane manufacturers like Boeing fall, and you can probably also see some of the actual airlines like United and American Airlines, Southwest, and such. They would also have fallen. They would. I'm trying to find them on the map. They, I believe, are usually in consumer cyclical, but they might be too small of an industry to be to show up, which is interesting to see. But across the board, There are definitely some industries more impacted, like the travel industries that have a lot of reliance on paying for fuel costs, which of course derives their prices from oil. But all across the board, we saw quite a bit of pain. We saw the S&P 500 fall almost exactly 5% in the past month. The top 50 stocks, so the mega cap names, performed slightly better at losing only 4.3%. So still not great. S&P GARP, so that's growth at a reasonable price. That's one of our preferred ways to invest. They're usually higher quality names. They actually fell more than the general market, falling 6.5%. Small caps performed a little bit better, so those are slightly smaller companies. Usually they're hurt more in a an emergency or in a crisis situation, but they've also been beat up quite a bit over the past 2 years. They've been sold off pretty significantly for in preference of the larger cap companies. So that I would assume is more so them having been oversold previously, even if this probably would affect their bottom line slightly more than the very, very large companies that have more of a dynamic way to avoid some of these disruptions. They are able to, vertically integrate some more of their supply chains and such that small caps might not be able to do. Global ex-US, which has been outperforming, so non-US companies, international stocks, they have been outperforming over the past year or so. A lot of investors have moved away from the U.S. After the new administration, the Trump administration, came into power to try to diversify, also with the America First policies and the protectionism and such, the isolationism. Some of the international companies, especially the European companies, seemed to be a better value, and also again diversifying. But we see this month where the countries that are across the pond, that don't have an ocean in between us and the conflict, and also don't have as much strong production of oil. The U.S. is the largest producer of oil in the world. Those countries are likely to suffer more from this conflict because of the proximity and also because of their reliance on oil. So we saw global ex-US stocks down almost 11% for the month. So almost, it was twice as bad as the S&P 500. So definitely seeing a lot of pain internationally as well. US aggregate bonds fell 1.6%. Usually you'd expect bonds to rally at least a little bit when there's crisis. People sell their stocks, which are riskier, and try to buy bonds. However, there are a few things that I would see that drove bond prices down, or bond total returns down. We saw some corporate bonds become less valuable. They're usually at least somewhat tied to the company's stock prices. But the other big change that we saw was that with the war in Iran causing oil prices to increase, that makes stock analysts, economists, and such expect inflation to be stronger, to be higher, because oil prices will affect the cost of your airfare. It will affect the cost of trucking, so transportation of your goods at the grocery store. Plastics are made from oil, so everything has plastic packaging. If oil prices are high, we expect inflation to be high. And one of the big themes of this year was the expectation that with the new Federal Reserve chairman that has been announced but not yet confirmed, that there would be cuts to the Federal Reserve's interest rate. And when the Federal Reserve cuts their interest rate, that's stimulative to the economy. It usually helps the stock market and it makes borrowing less expensive. But usually the Federal Reserve either increases rates or doesn't lower rates when they're afraid of inflation, to help protect against inflation. So higher rates protects against inflation, lower rates increases the stimulation of the stock market. So with the war in Iran causing fears with high oil prices and potentially high inflation subsequently. A lot of stock analysts have now expected that there will be fewer rate cuts. And so interest rates will be higher. And when interest rates are expected to be higher, bond prices fall. So it's an interesting, confluence that you see that usually you'd expect bond prices to rally in the face of uncertainty. But because of how interest rates are affected by inflation, which are affected by the oil prices, which are affected by the war, they also were falling. So very interesting. Hopefully that explanation made sense. So gold was down almost 11%, almost exactly what the international stocks did over the past month. Gold has been going crazy over the past few months. Some analysts have considered attaining meme stock status, where they were being traded, where there was a lot of volatility, retail traders hopping in, and there wasn't as much, let's say, like substance behind the investments. A lot of what we call swing trading, or just trying to get in and out of the investment, rather than it being a long-term hold, which usually leads to prices rising each subsequent period. If it's people buying and selling wildly, we can see big jumps over the past few months, and then we can also see big drops like we saw this month. Crude oil is the largest number here. We saw a 51% increase, and then the last index we have on here was Bitcoin, up 3.4%. Bitcoin pretty flat, actually, out of everything. It was the most flat other than the bonds. Bitcoin has had a tough start to the year, and it's been kind of a risk off trade throughout. Also, a lot of people have been preferring gold throughout this year, so they were selling some Bitcoin to buy gold, but we saw a little bit of a reversal this past month. I'm not going to spend as much time on the year-to-date chart. This is just January, February, March all together. When you combine all of them, the S&P 500 is about the same. The S&P top 50s, the largest stocks, are down almost 8%. So the first 2 months were slightly worse for the NASDAQ 100 compared to the rest. Small caps are actually up 3.4%. So again, where I was saying they've been beat up over the past year, it was a little bit of a rally, a reversion to the mean, as we call it in finance, where it was oversold and people thought that they were a better value. So year to date, small caps actually have been performing well relative to the rest of the stock market, the larger companies that have fallen. Global ex-US, almost flat, down 0.8%. A lot of the gains that it had at the beginning of the year, the first 2 months, were wiped out with the negative 10% loss over just March. Aggregate bonds, flat at 0.0%. No returns. I think it's 0.04 actually, but this is just rounded to one decimal place. So it hasn't been falling as much. This past month, of course, it fell about 1% or so, but it had rallied the first 2 months slightly. Interesting to see. Bond prices usually don't do too much, but it's not every day that you see the index be a flat zero. Gold up 8% for the year. Again, big drop this past month, but it had been rallying for the past few months. Crude oil, when you add the last 2 months, so January and February on top, that's another 25% or so. So up to 76% increase in crude oil since January 1st. Definitely, you can see that at the gas pump, and we'll see what will change in the future. It might stay at a relatively higher level for a while. We'll have to see. And then Bitcoin down 22, almost 23% for the year. Definitely was a little bit of selling at the beginning of the year, less so this month, but the first 2 months were not great for Bitcoin. So I'm bringing back the S&P 500 chart this month. I kind of put it away for the past few months, usually when not too much is happening. Showing the same graph over and over doesn't tell people much. I found that if I show the same graph and it's just the same exact lines of, okay, this is what happened where the tariffs over February through April last year, we see it falling, and then afterward, we saw big rallies where AI and other kinds of big Nvidia was doing well from April all the way to, let's say, October or so of last year, and then it's just been trading flat essentially from October all the way until the end of February. It was what we call either hitting a ceiling, or we could also call it consolidation. We could also call it just less demand. We've been mentioning, Gordon and I, in the past webinars, that we saw that with the big rally from April to October, that these prices, just the earnings of the companies at the prices that they were at, it was pretty expensive for those earnings. And we were ourselves with recommending to clients, we were saying, let's not be going super hard into the stock market. We're not recommending selling out of your investments. We're big proponents of passive buy and hold. Let's not try to time the markets. Staying invested is the best thing you can do for long-term wealth building. But when clients had excess capital, we were usually telling them to put into safer investments like bonds, or holding off and doing dollar cost averaging, buying a little bit each month. And we didn't know what was going to be the trigger. And we're definitely, we might not be out of the woods yet. But when stock prices are expensive, um, they have less resilience to crises. And so we didn't know that there was going to be a war in Iran, although on my entire life there's been conflicts in the Middle East, so it's not particularly surprising. But since the big conflicts with Israel and the U.S. bombing Iran, and then Iran closing the Strait of Hormuz, we saw quite a bad, February not doing too great, and then quite a bad March. A little bit of a rally over the past 2 days where there were some tweets that were, potentially considered maybe to say that the war is not going to be too bad, or it's going to be over soon, or whatever. I definitely find the markets untrustworthy, I guess we'll say, where the markets drop significantly and then they rally significantly on tweets. We had been there back in April where we saw, March and April tweets of tariffs, tariff on, tariff off, tariff on, tariff off, within a day or 2 days on the countries. And the markets were just taking what the president was saying at his word on Twitter, and or on Truth Social, his social platform. And when there's so much of the stock market is valued on what the market thinks a tweet might potentially mean, and what might occur based off of cryptic messaging from the president. We've very much tried to slow people down with their investing and say, okay, well, the war's still happening, and prices even at these levels are not particularly attractive. They're better than they were at 7,000, where the S&P 500 was at the beginning of the year, and now we're at 6,400 a few days ago, 6,600 after the 200-point rally over the past few days. I think, and I'm going to caveat this, that I don't think that you should be going out and just selling your investments or panicking, but I don't think we're out of the woods. I think there will be plenty of more volatility ahead, and it will not be comfortable. But that does not mean that you should sell out of the market and wait for it to be comfortable again to get back into the market, because that's not how it works. Once it's comfortable, the market will rally and you will have lost out on getting back in. Usually, yeah, say this is the bottom, and I'm not saying it is, but this huge rally in a single day, if this was the bottom and you were waiting until after the rally and then you bought up here, you just missed out on a huge recovery, and you could lock in basically losses and never get back to a point where you're making the stock market's wealth building ability work for you. So stick with it. Maybe be cautious about putting more money to work. For my money and various of our clients' money, we've been slowly dollar cost averaging potentially each week, a little bit each week, but not deciding this is the bottom. We're putting everything in all at once. Trying to be more meticulous, slower with our money, and not panicking too much. Hopefully next month when I show ideally this graph again, we'll see not necessarily huge rallies or huge falls, but a little bit we'll call consolidation where it's trading within a range and the market's getting comfortable where it's at. Where when there's lots of these ups and downs, you really don't know who's right. Is it the bulls or the bears? Who's buying or selling? Who's correct? But when we get like these small candlesticks where there isn't a whole lot of volatility like we saw in December or we saw in like August, that's when you're pretty confident in some of the stock market's pricing. Oh, and here is our supervisor Citrus joining the call. Hello. So that's all I have to say about the stock market and such. We'll talk more about it in future months. But let's quickly run through some notable events for the past month. And I only have 5, and most of these I'm going to try to keep relatively short. I'm not trying to have a super long webinar, especially without Gordon here. So the first of the 5 news articles I saw was that Nebius, hopefully I'm pronouncing it correctly. I don't actually know the company very well, but Nebius stock jumped 10% when NVIDIA, which is the largest company in the world currently, which makes computer chips, so designs GPUs, graphics processing units. So NVIDIA was going to invest $2 billion into Nebius. And so Nebius is an AI cloud company, so it's supporting these AI bots and companies with cloud infrastructure, and basically it's some of the back end on how these artificial intelligence softwares work. We'll see if this has any actual impact on the broader markets. We see NVIDIA doing a lot of these kinds of multi-billion-dollar investments into these tech companies. NVIDIA has had huge growth over the past few years, and I think that they're being pretty smart with using their capital, so the value of their company, to diversify themselves and buy into small portions of other companies that could potentially become very large in the future. Next notable event was Netflix. So, previous month we saw that Netflix gave up their bid for Warner Brothers. So they're not going to be buying HBO. They left that over to Paramount. But since then, Netflix is still in the news. Netflix has decided to hike their prices again, and we probably will continue to see that. I saw this great graph that I wanted to share, which this graph shows U.S. streaming services revenue. So Netflix, Disney, Peacock, HBO Max, and Paramount per hour viewed. So the revenue per hour viewed. And I would kind of describe this as the value of each of the streaming services. So this is on average. Maybe you like Disney Plus or Peacock or something more than Netflix, but on average, there's so much view time that Netflix has. I believe might just be in the US. So the US watches so much Netflix that it makes the price per hour that's being paid only 48 cents. So if you think about, going to a movie and you pay, $10, $15, $20 for an hour and a half movie, 2-hour movie, you're paying $10 for, let's say, for an hour spent. So this is a 20th of the price of the movies or such. And we see with Netflix, because so much is watched on Netflix, even with their higher prices, it's a good value. And so they're going to keep pushing their prices up. They're going to keep hiking to try to get their revenue per hour viewed higher and more in line with Disney, which is at 64 cents, Peacock, which is at 72 cents, HBO Max, which is also at 72 cents, or Paramount Plus, which is buying HBO Max, which is currently, of these five, the worst value per dollar spent. You spend on average spending less time per dollar spent. It's almost twice as bad of a deal than Netflix on average across the US. This is not saying that, again, you might love the shows on Paramount Plus, I'm not sure, but we'll likely continue to see Netflix raise prices because essentially they have the viewership. People want to spend time on it, and as long as people like spending time on it, they're likely to continue to pay higher prices. Yeah, moving on. So this is the last slide for the month. Just wanted to start out with another kind of small news item. This was a President Trump announces a news item. So we'll see if it is a President Trump announces and it becomes a reality in the future. We'll see. It's not always the same thing. But he announced that there's a $300 billion deal to make a new oil refinery in Brownsville, Texas, which is backed by India's Reliance Industries, which is, I believe, their largest or second largest, a very, very large company in India. And this will make it the first new refinery in 50 years on American soil. And it will process 100% American shale oil. They expect that it'll process 1.2 billion barrels of U.S. light shale oil valued at 125 billion over 20 years. So it definitely follows what President Trump has been trying to do, which is consolidate oil power. Drill, baby, drill, as he said. Take over Venezuela for the oil. I think it was yesterday where they said it was reported that Trump says that he would prefer to take Iran's oil, whatever that means. So he very much seems to have an interest in making the U.S. An oil giant, and we'll see if that is successful for him. As I would consider myself more of an environmentalist. Not usually a big fan of fossil fuels, but we'll see. We'll see. It definitely makes a lot of money, and it likely the more production of oil usually reduces prices and helps with lower costs for plastics and other things that would help the stock market. But it's also kind of interesting that the war in Iran to make this possible, to take the oil likely away from China, which China is one of the few places that was buying from Venezuela and Iran. Those the goal of trying to get more oil for the U.S. has somewhat backfired, at least short term, by making oil prices spike quite a bit. So we'll see. We'll see if this oil refinery actually does happen, and we'll keep you notified if I ever see another headline saying that it actually broke ground. We've definitely seen foreign countries and companies in foreign countries make promises to invest in the U.S. to appease XYZ president, and like we saw with Biden for various chips, and we saw for Trump in his first term and Trump in this term. Like a lot of these promises are campaign promises that either president is trying to follow through on, that oftentimes fizzles away when the president changes the presidency changes hands to another party, and the country or company that usually doesn't necessarily want to be investing in the U.S. because they could be making more money by offshoring and investing somewhere else, kind of it fizzles. So again, we'll see. We'll see what happens. Next topic. So we made a whole YouTube video on this Ticketmaster settlement. So just a quick brief summary. The U.S. Justice Department reached a tentative settlement with Live Nation Entertainment, which is the company that owns Ticketmaster, over allegations of antitrust violations. There were a number of provisions like a puny fine and Live Nation off divesting various of their venues. So Live Nation owns a lot of the venues that performers go and perform at, and then Ticketmaster sells the tickets. And because they own each other, there has been anti-competitive problems. We saw a big complaint back a few years ago with Taylor Swift and her Eras tour, and people not being able to get tickets, and Ticketmaster charging terrible prices and fees and such. That that's when it had gotten the headlines. And since then, not too much has improved, and the settlement is attempting to improve that. But we broke it all down. It had the video has not been posted yet. We're hoping maybe next week. Our video editor will be done with it, and it's just Gordon and I reacting to the news and breaking down what it means, and if it actually is going to have any kind of impact on ticket live ticket sales and such. We'll have to see. And then the second one here, of course, what is happening in Iran? The biggest news headline of the past month. It's kind of drowned out a lot of the other news, which is why we have some of the fewer headlines than we have in the past months. And honestly, I'm not going to go into it. I've talked about various effects on the market, what was happening in the stock market and such. But if you want to learn more about our take on what's happening in Iran and the impacts, we have made a full YouTube video. I think it's 20 minutes or so, called Boomer versus Gen Z Financial Experts React. What is happening in Iran? We recorded it a day or two after the missile started flying, and it was official. But so it's slightly out of date. There's been a few changes on, there are a few more people that have been blown up essentially, and oil prices are slightly higher than they were when we recorded the video. But in general, a lot of what we've said has stayed the same, and will have the same impact on the markets and such. So we're trying to, Gordon and I are trying to make more videos on the YouTube channel, trying to break down more of these news headlines and educational side of it. So if you're interested in learn more about Iran, or our first video about the Supreme Court decision on tariffs, or our third video that's coming out soon with Ticketmaster, please go to Silverstone Financial's YouTube channel and watch more. And you can have another 20 minutes of this webinar essentially, for those that are interested, and for those that are happy with what we've got so far. We're going to call it here a nice 35-minute webinar. I think it might be a record. It's been probably over 2 years since we've had a webinar under 40 minutes, trying to keep it short and sweet. And we'll make it a little bit longer and a little more in depth next month when Gordon's back. So I didn't see any Q&As come through. Hopefully that's because I answered all of them beforehand. Feel free, if you have any questions, to email us directly or contact us via our website. Check out our YouTube, or the podcast for previous months, and see you back next month. Looking forward to May's monthly market update webinar with hopefully good news about the markets. We'll have to see. All right. Have a great night, everyone.